But then we also need to look at the Finance Act 2020, and which has brought in the old versus new. And I have therefore said poetically, old versus new, finding the clue. The next few slides, friends, talk about the income tax rates that you will be having for the assessment year 2021-22. Because you'll have two baskets. You'll have to make a choice. Now, how to make a choice? That is going to be the key thing. And therefore, you'll have to start gearing up all your mental thinking on that subject. Now, I have tried to put the two scenarios. One is if you continue with the old. The second is if you opt for the new. Now, if you continue with the old, what will be your tax rates, friends? They are almost by heart to us. Up to 2,50,000 nil. 2,50,000 to 5 lakhs is 5%. 5 lakhs to 10 lakhs is 20%. And 10 lakhs and above, 30%. Please also bear in mind all prevailing deductions, exemptions, and reliefs can be claimed by you. You can also claim rebate. We'll see a little bit later in fact, both the situations. Now, if you opt for the new, the tax rates are up to 2,50,000 nil. Of course, the higher limits for senior citizens and super senior citizens of 3 lakhs and 5 lakhs will continue. But to make it simple, I have just kept the basics. From 250,000 to 500,000 is 5%. Then for every 250,000 bracket, you go up by 5% each. So it becomes 5, 10, 15, 20, 25, and 30. So 15 lakhs and above, you will come to 30%. But the important rider is that specified deductions, exemptions, and reliefs will not be available under this new section 115 BAC. Now, what is that? Here, old versus new, finding the clue, the package you get with the concessional tax rates. You know, it's a package. You have certain forbidden fruits and there's still something on your platter. Now, what are your forbidden fruits? The forbidden fruits for the salaried, LTC, HRA, 10, 14 allowances, professional tax, standard deduction, specified perks. Now, all these things which a salaried taxpayer used to enjoy until now, if you go for the new rates, the new package, you will not get that. As far as house property income is concerned, your SOP interest under section 24, which you get up to 2 lakhs, you will not get, plus the set-off of loss which you can allow, in respect of an SOP against your other incomes, that will also not be permitted. Friends, if you are a taxpayer having business and professional income, you get additional depreciation, specified deductions under 35, 35AD, specified losses, which you can normally enjoy. They are your forbidden fruits. You will not get the benefit of that. There are other sources, which are family pension, standard deduction that you get out of the family pension, 15,000, the income of minors under section 1032. You have the chapter 6A, all your deductions. The only two which are spared are section 80 CCD2 and 80 JJAA. Friends, 80 CCD2, as you are aware, is that in respect of your employer's contribution to NPS. That will continue to be available to you. And 80 JJAA is in respect of business profession when you are giving extra employment, etc. You are given the benefit of that. These are the two exceptions. In fact, it's going to be a whole lot of complication remembering as to what will be eligible, what will not be eligible, but then you'll have to get used to it if you have to work on this. Still on your platter, don't worry too much, because still, even if you go for the new rates, you'll still get what is shown on the slide. You'll get still on your platter for the salary. They are going to be notifying, this is what is mentioned in the Memorandum to the Finance Bill, that the transport allowance for the handicapped, the conveyance, transport allowance for the handicapped is 3,200 per month, 38,400 an annum. Your conveyance allowance, tool transfer allowances, which are there under 1014, they are also going to be notified that they will be eligible as exemption under 115 BAC, and all your retirement benefits. Fortunately, you don't need to worry about your gratuity, leave encashment, PF, and other things. They will continue to be exempt. In case of house property, interestingly, keep in mind if you are having rental income. Friends, in case of rental income, you will continue to get the benefit of interest deduction under Section 24 out of your rent. In SOP, you are not allowed, but LOP, yes. Then you will have a standard deduction for rent, which is there, 30%. Business profession, keep in mind that your business deductions and your losses, regular losses other than the specified losses, they will be allowed as a deduction. You have capital gains, which is fortunately untouched. All your deductions under Section 48, the benefit of indexation, exemptions under 54 family, etc., they will all continue. And other exemptions and rebate, like PPF, the Sukanya Samriddhi Yojana, tax-free bond interest, LIC maturity, agriculture income, 87 rebate, all these things will fortunately continue, so you have nothing to worry. Friends, I have a couple of case studies, and here is an interesting case study of Mr. Salaried, who has a gross income of 18 lakhs and deductions of 5 lakhs 25,000. I've just hypothetically put here so that you can have a better perception. This would include at the bottom, as is shown, salary of 50,000, housing loan interest of 2 lakhs, ATC 1 lakh 50,000, ATCCD, what you get for your additional NSS investment 50,000, ATD medical 25,000 and 50,000 for your parents, family and parents. That makes around 525,000. I gave this example close to it in case of rebate. Take here out of 18 lakhs, you're getting 525. So that leaves a taxable income of 12 lakhs and 75,000. And so as per the old rate structure, you will pay income tax of 2 lakhs 2,800. Under the new scheme, out of your gross income of 18 lakhs, the deductions are zero because none of these deductions will be available. Your taxable income will continue at 18 lakhs, and the income tax, even at the new rates, friends, will be 2,88,600. So tax saving of 85,800 if taxpayer continues with the old. Now we go forward. There is another case study, and that is saying the same case of Mr. Salaried. He is an HUF, where he's just trying to build up income. He has not taken any deductions. So he has gross income of 15 lakhs, deductions, no deductions, taxable income 15 lakhs, tax is 2 lakhs 73,000. In the new scheme, on the gross income of 15 lakhs, no deductions obviously, taxable income 15, and income tax will be 1,95,000. So there is a tax saving of 78,000 if taxpayer opts for the new scheme. Now this is the example, friends, if you recall having heard the finance minister's speech. she gave this example of 78,000. In fact, considering a situation that a taxpayer is not taking deduction under the old and new, and therefore I thought this would register better in your minds how this 78,000 works out too. So, we go further, and then I'll come to some of the Guru Mantras. Choosing the right tax regime. Friends, I tried to make it a little simple for your understanding that where total income, take for example, is 15 lakhs or more. In this case, what would be your tax differential and how would you choose between the old and the new? Say if you are claiming deductions starting from 4,50,000, you would still continue to save 62,400 under the old scheme. So progressively as your deductions reduce, your tax differential will also reduce. And what is the break-even point? Please keep this in mind. If your income is more than 15 lakhs, because under the new scheme, that is where you attract the maximum rate of tax. At 2,50,000, it becomes neutral. Both under the old and the new scheme, the tax differential.
It's 12 hours.
It's nothing is there. So you go further, then friends, you will start reaping the benefits. In the sense that when it goes down to 2 lakhs, you'll still save 15,600. If you are just claiming only 1,50,000 ATC, you should still go in for the new scheme because you'll save 31,200. If 100,000 is the deduction, you'll save 46,800. And obviously, we saw that, friends, if you are not claiming any deductions, the maximum saving is 78,000. When you cross the surcharge barriers, the surcharge will be added to that. But subject to that, 78,000 is the maximum tax benefit if you are not taking any deductions at all. Let's go to the next slide here. And here I am talking about the Guru Mantras. Friends, what are the messages that we take home from the slides that we have seen? The discussion we have had on old versus new, finding the clue. And therefore I say, make the right choice and rejoice. Now, how do you do it? I would say I'm going to advocate or advise for a combo, particularly for the middle class taxpayers. Now, where the total income, the first Guru Mantra is, where the total income is more than 15 lakhs, as I pointed out, the break-even point of deductions is 250,000. So where deductions, after deductions, the total income comes down to below 5 lakhs. Friends, the old scheme is invariably the right choice. Why? Because you get the benefit of rebate in case of all resident individuals. So just ensure, as long as the protection of rebate is there, and you can stretch your deductions with the rebate until 8, 9, 10 lakhs also, you are still safe under the old regime. Now, I have put the third proposition, which is worth considering. In a family with 3 tax entities, individual, spouse, and HUF, what would you do? Plan all possible deductions totaling to more than 2.5 lakhs in the case of the individual and stick to the old. For the spouse and the HUF, skip or claim low deductions below 250 and opt for the new. So that will be a win-win situation. See, today what happens, there are deductions which are scattered in the family. Something in HUF, something in spouse, something in individual. The strategy now would be to concentrate all deductions in the individual's entity where you can do the best, and spouse and HUF, or individual and spouse can take deductions and HUF at least. You can go for, based on the case studies I have tried to give, make a combo of the old and new. You can, I think, really make your day.